Hello and good morning to everyone. I hope you all can hear me well. I have to say this is an exceptional experience, sitting in my living room and talking to, at the moment, 48 people. First of all, I would like to ask you, you have Q&A and chat here, so please let us know where you're listening from in the chat part. And if you have any questions during the webinar, just please raise them within the Q&A sections. Welcome once again. My name is Marina Franolic. I'm Managing Director at Bench Events, also leading Idea Hotel Investment Forum, which was meant to be the hotel investment conference for the entire CEE region. And it was planned to be happening in Prague on May 19th and 20th. Due to this current situation, unfortunately, we had to postpone it. And if you were planning to attend it, please register. We will hold it. It's going to be on November 9th and 10th again in Prague. I definitely want to say that I hope all of you that are with us today, that you're well, that you're healthy, that your families and friends are healthy, and that you are experiencing this situation as a challenge and not as such a great problem that we all could, but hopefully we won't. Today, this is the first webinar that we're going to be organizing regarding the CEE region. And today with us, we actually have an interview with Dr. Daniel Thorniley. He's the president of DT Global Business Consulting. I want a warm welcome to Daniel, who's going to share the global and the regional economic outlook with us today. Daniel, welcome. Would you please tell us a little bit about yourself?
Thanks, Marina. I hope you can all hear me well. Danny Thorniley, I'm president of DT Global Business Consulting. Perhaps more relevantly, I'm president of the CEE and Russia Business Group. I've been working on CEE region for too long, about 35 years, and we've been independent and private for 10 years, and we run a group of 350 corporate companies on this part of the world.
Thank you. Well, I wanted to say one very interesting detail about Daniel is within his CV, it says that Sir John Major, the former British Prime Minister, called Danny the world's leading business expert on emerging markets. So I can tell that Daniel is actually the right person to tell us everything we need to know about the economy at the moment. I'm looking at your comments and I can tell that we have people from Dubai, from Sarajevo, from Trieste, Bucharest. It's really amazing that at least here sitting in most of us in our homes that we can talk to each other and get together. Let me just go through a couple of details which we call housekeeping. All of the attending participants here are muted, and the only way you can communicate with us is through questions and Q&A and comments. And I think that's, Mala, can we just have a slide on housekeeping details? Okay. And right, we're gonna have polls, and we're gonna start with one of them right after this introduction. And after the webinar, the recording will be uploaded on the IDEA YouTube channel. So whoever wants to listen to it again, or if you want to share it with your colleagues, please do so. We'll start with one poll that I really want to hear what our participants think. So just a second. So the first question that I would really like all of you to answer is, when do you think that the recovery of your country's economy will start. And the possible answers you can see is the Q3 of this year, Q4 this year, Q1 2021, Q2 2021, and not before Q3 2021 or even later. So we'll just gonna wait for a couple of seconds to get the answers from you, and then
if you press on your screen, you'll be able to press the button on your screens to make your vote.
Mala, is it on, it's not on Q&A. Where is?
You should be able to see it on the screen, on the actual screen that you're looking at. You should be able to see, and you should be able to
so we're getting the results on chat. Q3 2021, Q1 2020, Q3 2020, Q1 2021. So it seems that most of the participants actually think that nothing before September will start to get better. And then Daniel, coming back to you, I think now it's your turn to actually tell us. Global economic outlook for 2020 is something that no one really is able to completely to predict. But in your latest analysis, you have pointed out that we have a couple of scenarios, and of course, among them, we have the best and the worst case scenario. Can you share with us? Can you tell us what is the current situation of Q1 and Q2, and what can we actually expect until the end of the year?
Thanks, Marina. And if I get too enthusiastic and talk too long, I know we've got a number of questions and finite time. Feel free to interrupt me, but I'll try and confine my answer to maybe 5 minutes. This is unprecedented territory we're in globally, and I'll talk about CEE, but globally, this could be the worst economic crisis for 500 years. That's to be seen. The unemployment rate, for example, the worst in the United States of America in 1929 on a monthly basis was 600,000. And last week in America, it was 3.3 million. So that's 5 times worse than the worst of the 1929 depression in the United States of America. As you've said, there are unknowns. When does the virus end? Will it get better soon? And as in your survey there, the client surveys I've been doing for the region suggest that there's some hope for the start of Q3, but really most people are thinking the start of Q4 for the start of the recovery, not the full recovery, the start of the recovery. That will depend on medical, it'll depend on the weather, and it'll depend whether we've reached the peak in Italy and other countries. I am particularly concerned about the United States of America. They do not have a functioning public health system. Maybe after this, they'll decide that they want one, or maybe they don't. But certainly the trend in the United States is the biggest concern at the moment. China seems to have been able to control the virus to some extent. And I think everything you said there regarding the results and expectations for the pickup is correct. So I'm thinking we're going to have a brutally bad Q2. I've just seen today the announcement from Hungary that the purchasing manager index is down to 29. This is the worst number in history. This index was at 40 during the 2009 crisis, and today it's at 29. We've got more to come. We think that GDP in the United States in Q2 could be year on year, quarter for quarter, could be -10, -15, and Goldman Sachs is looking at -25. We've never had a period where we're waiting for the government money to kick in, but it's the service sector, the SMEs, hotels, tourist industry, cafes, restaurant, bars that are closed. During the Blitz in 1940 in Britain, the theatres were closed in October 1940. But they reopened after 4 or 5 days because they realized they could go to the theatre during the day because the bombs fell at night. In Britain today, the theatres are closed for weeks or months ahead. This is just one little anecdote of how the service industry is changing. We didn't enter this crisis globally very well. The gig economy, part-time work was masking a lot of consumer stress. Real wages were falling or flat in the UK, Europe, and in North America for 10, 20, 30 years, unlike in Central Europe. And Central Europe, relatively, comparatively, is entering the crisis with a little bit of fat. That won't help so much because it's the global impact through trade, investment, confidence, etc., which will do the damage. The Central European region cannot avoid a recession, and it's just a question of how deep. Staying with the global, though, I think both globally, we've seen the packages of major investment and subsidies and grants. When we see the word loans, I'm not too excited because loans to crippled companies and weak sectors is not so good. We need grants, we need subsidies, and most of all, we need income support. In the United Kingdom, the British Conservative government has nationalised wages. This is Soviet war communism from 2018. Even the United States of America has tried to back up unemployment insurance, and this is necessary. I think, by the way, in Central Europe and Russia, we only started the support fiscal programs. Of course, on the monetary side, globally, interest rates, if they were not already zero, will be zero and in negative territory, further negative territory. There will be quantitative easing, and the same in Central Europe. Central Europe has only just started the fiscal support needed for these economies because, as we were saying before the call, Marina, if we've reached the peak in 2 or 3 weeks, and if we can have a recovery in 1 month, then it might not be that bad. That, however, is the very best case, and it doesn't seem feasible with the state of the United States of America at the moment. So this looks like going further and deeper, and every day and every week that the service sector and the restaurants and bars and hairdressers and trainers and personal coaches are not working clips off something from GDP. Just to give you some idea and some guesstimates of where we are, I believe every economy in the world will be in negative territory this year, except perhaps for China. China will come down from pre-crisis estimate of 6% to 2.5, 1.5, but the global economy, instead of growing 3%, will be down -2 to -4. The United States, instead of 2%, pick a number, will be -2 to -4. The Eurozone, of course, is very badly hit and was in a weakish spot starting. The very best case was -2, but most commentators now see -4, -5, and that, of course, is being led by Germany. Just as an intro, and then I'll stop, Marina, for Central Europe, a few days, in a 6-day period in the middle of March, the consensus moved from +2 to -4, and that was in a 6-day period. This is for the Central European region, Southeast Europe, excluding Russia and excluding Turkey. So I think for the whole CEE region, we're looking now at a sort of a consensus view of very best case -2, -2.5 GDP growth, but probably -4. And for individual countries such as Czech and Slovakia, very integrated into the Eurozone, it could be worse. But I'll talk about Central Europe in a few moments.
Thank you, Daniel. This was not really encouraging, I have to say. I was looking forward to some positive numbers.
I can do those for you if you want, if it'll make you feel better.
Yeah, I know. Well, I just want to compare a little bit the financial crisis that we had in 2008, 2019, even though I know that everyone says this is not even close. But my question is, how long did it take for CEE to recover from that crisis? And compared to Western Europe, how longer? So can you give us a little bit of that, and then we can ask you right away, how long do you think that the recovery will last? We saw a couple of answers here from the delegates, but what is your opinion about that?
Sure. Well, 2008, 2009, as we all know, was really instigated by the finance sector and hit the finance sector. And the difference there, of course, was the shops were open, the bars were open, people were having cafes and so on. So that's the big difference. At the moment, before non-performing loans kick in, at the moment, the banking sector globally and in Central Europe seems in a relatively decent place. But that could change if the crisis deepens and lasts a very long time. I'm pleased to hear that in the United Kingdom yesterday, the banks were forced to stop share buybacks and to pay dividends this year, because of course they're going to need all the capital that's possible. The problem, I think, compared with now and then, is that the banks will be able to lend, but will enough people want to borrow? And also the banks always go into the mode of, we like to lend to very successful, profitable companies, but we don't like to lend to losers and those who are high risk, which of course is what we probably will need in the developed markets and in Central Europe. To answer your point, I think the world never recovered from the crisis. And again, if you look at consumer product sales, retail sales and so on, the consumer, real wages never picked up after it. And the consequence of that, because we went into austerity mode after that crisis, the consequence was that 6 years later, we had Brexit, we had Trump, we had populism. I would just want to say before I answer the question, I don't think the world is mad enough or insane enough in 2021 to go into an austerity mode. We will have trillions of euros of new debt accumulated by governments, and that must be either written off or put into 1,000-year euro bonds at a 0.1% interest rate. If we go the route in the Bundesbank next March by saying we must pay off the debt with austerity measures, and let's say cut health spending, for example, then we would be walking into social, political, economic revolution. I don't think that's the scenario, because countries now have seen that they need income support and fiscal support. To answer your question, Central Europe generally was struggling until about 2013 when the Eurozone picked up. The algorithm I used to use was that when the Eurozone grew 1%, Central Europe grew 1.3% GDP. And that was a truism and reasonably accurate. And we saw that pick up in Central Europe, and then Central Europe performed better than Western Europe and the rest of the world. Until a few weeks ago, Central Europe was the best performing economic business region in the world, in my opinion. We used to circulate a document until a few weeks ago called Central Europe is Great. And we pointed out for business sales, for economic growth, for consumption, consumer confidence, pick 50 indicators why it was good. It was trending down a little bit already in 2019. The automotive sector was slowing. But now, so it picked up in 2013. It had a 6-7 year good run. We saw some cyclical slowdown at the end of last year. So we thought that the region, instead of growing 3 or 4%, would grow 2 to 3%, still decent. And we thought that business would trend down. Already, by the way, business was in single digits. Good business growth in Central Europe meant for 66, 70% of companies growing your top line in local currency at 4, 6, 8%. But that was decent growth in which were already maturing and nice volume markets. But I think now, just everything will depend in the globe and on Central Europe. What we said before, Marina, how long will it last? Because that will dictate how long the recovery will be required. There's another big question. After this, will nothing change, or will everything change? What's the future of work? What's the future of offices? How will we manage debt? Will the government stay involved in the economy? What will happen to short-term and long-term unemployment? I am fearful that given that there'll be lost capacity no matter what happens, so next year companies will have gone bust throughout the region, throughout the world. There'll be a pickup and a rally next year. This is a very important point. I think on most central scenarios and our executive estimates, we all believe that there'll be some kind of a rally starting sometime the end of this year or the beginning of next year. Instead of big negative growth, we're going to get growth across the CEE markets of +3, +5, +6% as the rally. And from a business perspective, it's going to be interesting how you plan for that recovery. So a short-term brutal crisis in this Q2, probably not a good summer, the start of a rally at the end of the year sometime, the final months, and then building hopefully into a rally. The worst case though, and God forbid, is that the virus abates and comes down during the summer, and then seasonally in the winter returns, just as when we've switched off the shutdowns and so on. If the virus returns in October in any manifest form, then of course all bets are off, all our estimates are off. We might have to repeat this process or not towards the turn of the year, and that would change the game entirely. But I think a big question, Marina, is will societies and politics and economics and the business model change or not at all? You know, what's going to be the return on capital next year or for the next 5 years? What's the return on investment? Trade will be down, investment will be down. So I think, will there be no change or will there be massive change?
And which countries, Daniel, do you think that within CEE are going to be hurt mostly?
The consensus view on GDP is that Czech and Slovakia will be badly hit on the logic that they're more integrated into the Eurozone economy, closely linked to Germany and closely linked with automotive. Automotive is going to be a big contamination economically. It was, as I said, it was starting to be that at the end of the year. But of course now with European and global auto shutdowns, temporary shutdowns across the Central European region, which, as we all know, impacts on supply chains as well. That's going to be very brutal. However, Poland and Romania and Hungary are also automotive dependent. If anything, we probably would guess that Poland might be a market that survives a little bit better because it went into the crisis so very super strong. So relatively, economically, Poland had more fat, whale blubber around it going into this. Curiously, the Romanian leu has not depreciated much this year, 2020, until yesterday. Romania, you might think, with a higher budget deficit and current account issues, political issues, brain drain, some instability, might be more at risk than others. So we see Czech and Slovakia GDP, Romania possibly. The Hungarian forint has underperformed the others, and amongst our clientele of the currencies, which have done not too badly against the euro, they've fallen about 5 to 8% this year against the euro. The Hungarian forint is seen as a little bit of a weak link potentially. The markets like Ukraine, Turkey and Russia are more volatile because their currencies are much more volatile than the Central European ones. So in Central Europe, I would suggest to you, we don't have much of an imported inflation threat, not much. But in Russia, of course, with the ruble down 20%, the hryvnia could be under pressure, and the Turkish lira, you might get much more currency volatility and some inflation impact on those markets.
Altogether, I have to say, it doesn't sound like a great future. But let's go on. I don't like to be negative, I have to say. Well, we've seen in the last couple of days that there are some governments are taking measures to help their economies to survive this period. What is your opinion on their measures? Are they structured? How well? Will they be enough? Will they be have to increase? How much money? We've seen states giving 2 billion. Am I correct? So especially in CEE, have you seen that some measures are maybe better than others?
Sure. In the United Kingdom, the Chancellor, I think in 8th or 10th of March, made a budget, a crisis budget, and allocated £12 billion towards the crisis. Let's say that was the 10th of March. And some members of Parliament thought that 12 billion was a little excessive. 12 days later, that crisis fund went from £12 billion to £320 billion for the United Kingdom. And as I say, though, they've nationalized wages, which I think is the necessary approach. So when, Marina, you talk about 3 billion, if that's for the region or for a country, I have to say that's pocket money. And I think every day now, and if the PMI from Hungary, PMI is a confidence indicator in some ways, but it's showing the way. And as I said before, if we have even 1 month or 6 weeks of this, which seems likely, then the support and fiscal support will have to be much more considerable. So 5, 10, 20 times what we've seen already. The good thing for Central Europe is the average public debt regionally is 46% going into the crisis. European Union average 100, Japan 250, Italy 180. So there's a cushion here on the public debt side. And the budget balances, they've weakened a little bit in recent years, but Poland's budget deficit is minus 0.7 when minus 3 is considered a bit risky. So again, the spending, even within normal monetary and fiscal terms, there's room for maneuver. But as I say, I fancy if we go to the mid-case, worst case, then normal fiscal monetary policy just goes through the door. The Eurozone trashed its own fiscal policy, which it stuck to for the last 15 years. And on the 23rd of March, it just said, our fiscal outline guides are now redundant. So I think that's where Central Europe will go as well. I think eventually, if the service sector is closed down, locked down for more than a few weeks, then as I said, income support, tax deferrals, loans, subsidies, yeah, all very fine and dandy, standard normal procedure. But I think we need to get to income support, putting people maybe on short-term hours, and then the government saying, okay, a company then, you bring people down to 80% of their time and we'll fill the 20% gap, or 50-50, or whatever. Monetary policy, the central banks across the region have already started, and interest rate levels are not high in Central Europe, but they're higher than the Eurozone, which is negative, higher than Britain, which is negative. So I think interest rates have started to tick down in Central Europe. I will not be shocked if all interest rates across all of Central Europe are zero in a few weeks' time. And then, of course, we've already seen Poland has started some quantitative easing. I think we've got several governments who will want to push the boat out. Poland, Hungary, they're populist in the sense that they want to spend and protect the economy, and they've done well. I'm not making a judgment on populism, but in terms of economic expansion, they've done well, and that provided political support. But even the Czech Republic will not hesitate. Romania also, I think, politically will also push, and there's going to be few fiscal conservatives out there. So we've just started, more to come.
I would now ask everyone, whoever has the questions, just to write it in Q&A, and I would raise the first question that we have received. I don't know, Daniel, if you see it.
I can see the chat.
So it's the Q&A, and it says, we have a paradoxical situation. The crisis exploded in China, and yet China will get out of the crisis as the least hurt economy. So will other countries in future require China to act together in terms of sources of crisis, food safety, hygiene, etc.? this is second or even third global crisis that originated in China for the very same reason?
Well, there's an American who calls it the China virus, but I'm not going into that territory. But certainly the Chinese will look at themselves. I think they will come out of this reasonably well because, well, sorry, the first point is, yes, it's the China virus. They shouldn't eat wild animals or put wild animals next to their domestic animals, etc. And the Chinese will want to stop this to save the world, but also to save China, to save the Chinese economy, and to save the Chinese Communist Party and leadership. So I think, yes, there will be reforms. Where I see China coming out perhaps better is people will say, well, hey, they caused it, inverted commas, perhaps, but they also were the ones who were able to best control it. And we've seen the figures for US and Italy exceed China, and probably Spain and many other countries will exceed China. China's influence, I think, was already, we know this, for 10, 20 years, and in the last couple of years, the Belt, Silk Road, etc. I think that trend will continue from 2021, 2022, and onwards. The next century, this century we're in, belongs to China and Asia. And I think the way Europe and also remember this, the financial crisis was the American virus. So if you want to do tit for tat, silly talk, we could go that route. And the West now, I think the way people see the US handling, Hurricane Katrina and disasters, and the question of how fractious and dysfunctional US politics are and US society raises massive questions. And as I said before, I'm flipping from China to the US now, just to put it into context. Maybe President Trump will now say, wow, we do need a public health system. Obamacare is fantastic, and President Obama is the greatest president who ever lived. By the way, on a webinar, when you do a sarcastic joke, it's not always easy to tell. Just to tell you, that was a sarcastic joke.
Up to one point, I thought you're serious, but then the last comment just showed your opinion. Okay, let's move to the last point here, and we have another 2 questions. We're going to raise them after this one.
Sure.
So many companies had to lay off big percentage of their staff. Do you have any data on how much of the workforce is unemployed? And as that will obviously affect the spending power, which then at the end will again have effect on the country's economy power. So what can countries do, or what are they already doing to compensate this loss? And do you think that, as we all remember that this employment price was just bursting for the last couple of years, it was really high, the price of the workforce. So you think that this is going to lower now that many people are actually unemployed and they might be willing to work for less than before?
Thank you. Mega question. I need about 1 hour to answer it, but I'll be shorter than that. Unemployment in Central Europe was 4.6 last year in the region, and we expected it to rise to 5.2 this year in a normal pre-crisis environment. I think in Q2 and Q3, as in the rest of the world, quarterly unemployment could rise, and it's an intangible, the service sector, part-time work, non-registered workers, but real unemployment in Q2, start of Q3, could be 8, 12, 20%. Those are numbers which are being thrown around for the United States and United Kingdom. That's short term. Now, we hope and trust there'll be a bit of a rally. The first 2 months of the year, January, February, were pretty good for business globally and in Central Europe. If we see a sort of a partial recovery end of the year, let's say the last 3 months are not bad. So we had 2 good months to start with, 3 months not too bad. So we've only got 7 miserable months, which is enough to destroy everything. To your point though, unemployment will rise, and I'm guessing that average annual unemployment in the CEE region will not be 5%, but anywhere between 6 to 10% as an average. Now, your point about wages, very tricky territory. Corporations globally have been trying to push wages down very successfully for 20 years. Real wages across the world, not Central Europe, in the last 10 years were flat, negative. In the United Kingdom, in 2015, they were the worst for 500 years. That was a contributor to Brexit, by the way. Central Europe, as you pointed out, Marina, was very different. Wages were good, unemployment was low. Now then, companies, excuse me being a bit personal and lackadaisical in my presentation, but companies didn't quite get it. They were moaning and groaning about, oh my God, wages are high, labor's tight, moan, moan, moan. But remember, when workers have money in their pockets, they go out and buy things. And Central Europe was a strong economic business environment region. Central Europe was the best and sustainable consumer products market in the world, competing with China, per capita sales, growth sales, whatever. And that's a consequence of people having money in their pockets and jobs. Okay, so maybe next year, I do think long-term unemployment will increase. I think some capacity will not be taken up. I think some industrial sectors will never be replaced. There'll be new digital competitors coming up, but they won't be able to fill the gap, I think. So yes, I think globally and within Central Europe, nominal and real wages next year and the year after will be lower. And I think that will be bad for business. It'll be bad for consumption. And that could turn Central Europe into, you know, the retail market of Germany 2-3 years ago, or the retail market of the United States or Britain 2-3 years ago, which is not very good. Central Europe was different and better. Be careful what you wish for.
Okay. Tricky, and I have to say, we'll all be here to see what's going to be happening in the next 6 months. Mala, can we just, as we came close to the end of the interview and we'll continue with Q&As, what I would definitely like to mention is the webinar that we are having in 2 weeks' time. So from now on, every 2 weeks, we're going to have a webinar regarding the either economic situation, hospitality, investments. And the next one is going to be in 14 days, so on April 15th. And we're going to be talking to operators and STR, and we're going to have Hyatt, Accor, and STR at the moment confirmed as speakers. So that's also going to be interesting to hear how the industry itself is coping with the situation. Also, what I would like to mention to everyone is that Bench Events has started it's starting the virtual conference on April 7th. So the first hospitality, it's called Hospitality Tomorrow. So the first hospitality online virtual conference is taking place in 6 days, next Tuesday. And the website is www.hospitalitytomorrow.com. Mala, would you just please show us the link? So please register, it's free to attend. And yet, if you wish to pay, all the 50% of all the donations, of all the amounts will be given to donations to COVID-19. So I really hope that you will be joining Hospitality Tomorrow, as well as our next webinar in 14 days. But I would now go back to questions, and all of you who do have some questions for Daniel, please write them down now. And I'll just read the next one. So it says, once we go back to normal, do you think modes of travel will have changed? Less flying, more driving, increasing train use. Also, how will local national air carriers fare? Will they be so many companies going bust, being bailed out of by government and or consolidation? Thanks, Tobias. Hi, Tobias. So what I'll just add to these questions. Do you think that consolidation is something that's going to be taking place again and more now that some companies will go bust and others, because of their other model of operating, will actually have extra money to spend?
Sure, Marina. I think, yes, monopolies and the big corporates, because of their war chests, will survive better. One of my clients pointed out to me this week that, you know, he's in a big company, industrial company, we will survive, but what about our distributors, partners and customers? And that's a very clear point. I do think travel, well, this comes back to the point before, will it be all change or no change or somewhere in the middle? And I think certainly for a couple of years, travel modes and mentalities will change. I would hope that there'd be a little bit of less egregious flying around the world, and maybe the budget flyers should be taxed more, and maybe the young generation or not will change how it wants. So I take your point on train travel and so on. The question of climate change was already coming to the fore before this crisis, and probably will be elevated on the agenda going forward. I saw one comment on the chat as well, Marina, from Raoul, that Q3 2020, suggesting that there'd only be travel within the EU region, local and regional travel, not from Russia, China or the US. I don't think, of course, that's official policy at the moment, and it's an opinion. It's interesting. You know, I think you're a bit not upset. I think you've been interested in my gloomy approach to the world at the moment, but that one on travel, if it's only regional travel in Q3 of this year and not this international travel, which is plausible, then that also will be a restraint on trade, business, confidence, and of course the tourist sectors. That takes us, I'm sorry, Marina, I'm cheating a bit. I'm looking at another question on the hotel sector, and I think there's a lot of expertise on this call. We all know it looks awful for the next quarter or so. Everything depends on the timing of the recovery, on the timing of that travel, and also on the timing of confidence. I think there'll be contradictory factors. I think many people will say when it's legal and travel is available, they'll say, my God, I want to get on the plane, I want to get to the beach, I want to get to the hotel, and you'll have a relief pickup rally, of course. And then the flip side, of course, is many people will say, okay, I can travel now, I can cross the borders, but I don't really want to. I'm not that confident. On the other hand, though, they may do domestic national tourism. So hotels then will benefit from domestic tourism, if I can call it that, but there'll be less of the high rolling, luxurious Chinese high flyers coming in. So I think the luxury sector will benefit from that pickup, but also the other factor as well from the Chinese and Russians maybe. And I do think that all sectors of consumer products, and if I may put hotels in that sector, promotions and discounts, you know, the consumer, the hotel guest was always king and queen, and they certainly will be now. And, you know, monopolization, Marina, but I think also if we've got an oil war a price war in oil, we're probably going to have price wars in many consumer products, including the hotel sector, which was already developing anyway.
And I have the last question here is, well, I have to emphasize that Daniel is an economist. He's not that much in hotel business. So the question is, what is your opinion about ongoing hotel projects in the region? Will they stop altogether? Will they get any support from the banks or investment funds or some recovery funds from the government? Or we need to shut down everything and wait for some better times? Daniel, do you have any opinion about this, or would you?
No, I do, but I'd wrap it up in, you know, hotels, but also other projects as well. No one is, hang on, there's some, in Austria at the moment, there's some building going on. Some apartment blocks are still being built. Those that were close to finishing, where there's internal electrical work going on, that is being carried on. But broadly, I think, projects that are just starting or are in their initial phases or halfway through, projects that were just being negotiated financially, I think will be mothballed. No bank or no investor this month, April. It's April Fool's Day. Oh, that's good. April Fool's Day. No one on April Fool's Day will want to invest in anything for another month or so. So I think we have postponement. And, you know, if you can manage a month, then all well and good. But obviously, I think the investment finance mood globally in any projects, including hotels, would be very sluggish, very tentative for this quarter. Because I'm sorry to say, I think on the virus and economically, and we just saw this number from Hungary today, which was atrocious, every piece of economic news looks like being bad now every day of this month. Even Trump said yesterday, the coming weeks will be very, very painful. And that coming from Trump is indicative of something. The flip side, if there is one, let's see what's happening to the numbers for the daily increase of cases in Italy, Germany, and we might get a little bit of light there. And remember, Marina, the markets only want a little bit of light. They'll grasp at any good news. You'll see the stock market jump up 2, 4, 5% anytime you hear that the Italian rate is coming down. But as I say, the flip side to the flip side is that those American numbers must surely be bleak coming up.
Yeah, I'm one of those that goes really optimistic when it sees even a small recovery of this situation. If we don't have any more questions, I would like to thank Daniel, and I would like to tell you all that so we will have the recorded webinar on the YouTube, but all of you will also receive the Daniel's Global Outlook report issued on March 23rd via email. I thank you, Daniel. I thank all of you for participating today, and I really do hope that you had a good time, that you heard something that was interesting for you, that you're not going to be pessimistic, that you're going to be hoping as much as I am for this, the lowest impact future, that we will all learn something from that, and also that you will join us in next week in Hospitality Tomorrow, and in 2 weeks in the new webinar. Daniel, thank you so much. Do you have anything else to say to our participants?
No, just to say I'm really a happy-go-lucky, funny guy normally, and you know, just the truth hurts.
Okay. Thank you all, and I wish you all a great rest of the day.
Same to you. Thank you. Bye-bye.
Bye.